Here, I'm going to have Train Wagman to do this part of the presentation. Train, you want to say hi to everybody?
Yeah, thanks, Robert. Good evening, everyone. I appreciate everyone hopping on late tonight. My name's Trey Wegman. I'm the VP of Sales. I represent Allianz, the RYLA strategy that Robert has touched on here. I'm going to keep this real brief. I know Robert's got a bunch of other stuff to kind of touch on, but if I pique your interest, please reach out to Robert to hear more about the story. It's really, really powerful, especially with what's going on right now in the markets. And I think, there's four main challenges right now that investors are facing. You have sources of income, you have longevity, you have inflation, and you have taxes, right? With sources of income, we have savings. Some people have a pension. Obviously, they're not as prominent today, but some people are lucky enough to have a pension. You have Social Security. Obviously, you have your full or part-time job. And then, with longevity, people are living way longer. We have better medicine. There's going to be more years spent in retirement. The probability of you and your spouse living to age 85 is over 80%. So what does that mean? That means you're going to have to save more money. Inflation, we all know what inflation is. We've definitely felt that over the last year or two. I think last year it hit 9% inflation. Think of what eggs used to cost. You go to the grocery store, eggs would cost $1.99. Now you're looking at $5, $6, $7 for a carton of eggs. So how are you going to make up this cost that we didn't really plan for? And then obviously taxes, dreaded taxes, we all have to pay them. And so those are kind of the four main challenges that investors are facing. And there's tons of noise right now out there in the markets. The S&P 500, which is just the 500 largest companies on the stock exchange, was down as much as 25% last September from its highs. You obviously have, Silicon Valley Bank, a lot of problems with regional banks across the country. We have election issues, geopolitical issues. There's tons of things that we hear about on a daily basis that has investors really scared. And there's not really a lot of safe places right now for your money without giving up the upside. So, how are you going to keep your money safe, but also, keep up with inflation, keep up with longevity risk? So that's really where these RILAs come into play. There's no fees at all with this story either. I know a lot of people here, the main concerns with annuities are cost and complexity, right? A lot of people assume they're very, very expensive and they're very, very, very confusing. But with our story, there's no fees at all, okay? No fees to your clients. And all we're doing is we're mirroring the S&P 500, okay? You can see all the different indices there. We have the S&P, Russell, NASDAQ. We have tons of different indices you can choose from. So you can diversify across the 5 different indices, or if you want to keep it simple and just choose the S&P, you can totally do that. But our story, it's a 6-year commitment, okay? It's uncapped upside based on the S&P 500 with a 10% buffer. And what that means is if the S&P, let's say over the next 3-year period, is down 12%, okay, you would only lose 2% because we absorb the first 10% of any market loss. That's what the 10% buffer is. We are buffering from 10% of any market loss based on the S&P 500. And you get uncapped upside. So whatever the S&P does over the next 3 years, you would get that. Let's say you put in $100,000, okay? Over the next 3 years, the S&P is up 100%. Your 100 grand is now worth 200 grand. So super strong story. We have tons of different options down there. Even if you're a really nervous Nelly client because of everything going on right now, we have 100% protection. And then as long as the index is flat or positive at all over the next year, you get 8.3%. Okay, put in 100,000, the S&P is up 2%. Your 100,000 is now worth 108,000. And you can't lose a dime. You're not paying any fees. You get tax deferral. So our story is very, very simple. And it's a great way to protect you on the downside, but also give you the ability to earn the upside to keep up with inflation, keep up with longevity risk. And if you want to hear more about the story, definitely don't hesitate to reach out to Robert after this. I can even join you for a call as well to dive deeper into the story. But I'll kind of leave it at that, Robert.
Okay, thank you, Trey. And also for those of you, you can see 100% principal guarantee, and the next level will be like a floor with minus 10%. So that means the client can, the most they can lose is about minus 10%, right? Trey?
Correct.
Yeah,
That's
okay.
the most you could ever lose is 10%.
If you choose, you put your money in this pocket. And also the upside, for the upside, you have up to 20%, or SP 500 will be like 12.75%. So which is not bad. Okay. And then the other tools also with 10% buffer. Okay. So a lot of options there. If you count that, there's like if you regard this as like a separate pockets where you can put your money in, that will be like a close to 20, more than 20 pockets, right? For you to put money in. So very, very diversified. And this is for the New York. So Trey, you want to talk a little bit about New York? What's the difference?
Yeah.
Yeah,
I'll talk about New York. So New York is a little different animal. They have a little bit more rules, so we had to make a customized version just for the state of New York. But you can see there, we still have some uncapped upside with 10% buffer. We even have a 30% buffer on our 1-year segment. So over the next year, okay, we will cover the first 30% of any market loss. So, that's pretty much worst case scenario. In 2008, the S&P was down like 38%, right? That was worst case scenario. Usually, on average, the S&P falls intra-year around 15% at some point throughout the year. So we're doubling that from a protection level, and then you can still earn 10% on the upside each and every year. So tons of protection. Keep up with equity exposure with 10, or even if you did the 10% buffer, we have a 20.5% cap. You can see we still have 4 different indices you can choose from. And then we also have some uncapped strategies as well. If you just want complete upside with still protection on the downside. So New York's a little different, still no fees, just some deeper protection levels there with that 30 buffer that you might find attractive.
Yeah, and also, do you know how many times in a given year that the stock market go down like more than 30% in the past?
It happened, I think, during COVID in March of 2020, 2008, 2002. There hasn't been, probably a handful of times where the market's actually been down 30%.
Yeah, and the other day I checked the SP 500. If you are talking about a stock market, I'm not sure, but I did check with the SP 500 since inception, 1957 till now. There's only 1 year that the stock market went down more than 30%. So that's the year 2008 to 2009. So
Yep.
So that's the only year for the SP 500. And if you look at all this 60 years of history, there's only 4 years in the stock market. I mean, the SP 500 is negative. Okay, so that's how great it is. So I think if you have your money here, I mean, you hardly can lose a penny, But yeah, that's a great protection. And also we have another one which is 20% protection for New York, 20% buffer. Okay. So the company will absorb 20% if the market is down more than 20. Okay. So great. Okay. You have anything to add on, Trey?
No, like I said, it's a very simple story, no cost. You get the tax deferral. It even comes with a death benefit. It's just a great way to, help you sleep at night, knowing that you have those buffers on the downside. So when you do see the volatility in the market, you're not freaking out. and you can keep up with inflation, keep up with longevity risk, stay invested in equities, but just help you sleep at night with those buffers on the downside.